Well, they might say, you know what? Well, that's just too much work. Maybe I'll just invest following the insiders, what they buy. That sounds like a good idea because they know all the company. Well, it does. It sounds like an easy thing. Just do what the insiders do because they obviously know the company pretty well. If the stock were to drop in value and the insiders commit to purchasing shares, well, it must be a smart investment. Well, unfortunately, it's not that easy, and there are many other factors involved. Data also shows that longer term, it may not even matter. Over my 45 years of doing this, I have seen sometimes when they borrow money from the company will loan them money to do the share purchase, which is crazy because they have no risk in the game. And I've seen that happen. And just like, no, you want to make sure they're committing their own money, not getting money borrowed from the company.
Yeah, I mean, you kind of talk about when they are committing their own money, does the stock do well afterwards? That's the important point. That's what we want to know. Should we be following them? Well, Wall Street Journal did an analysis of 1,400 publicly disclosed insider purchases using S&P 500 companies, and going back to 2020, they discovered insiders at 327 companies had a total of $3.7 billion in stock trades over $100,000. Most of the purchases were completed after a decline from the previous 30 days and produced a median gain of about 2% a month later, but then began to decline after that.
And the numbers also show that only 15% of the purchases fully recovered from where they had fallen in the previous 30 days before the share purchase. It should also be noted that they cannot act on the insider information. That's so important because, oh, this is great. They know things. If they know something really important, they can't talk about it. They can't act on it. They'll go to jail if that happens. So if there's something major that they can move the stock either up or down, again, they're probably not going to do that. They won't do it because they risk the fact of if they get caught doing it, they're going to jail.
Yeah, not worth it. And
not worth it at all.
Again, in other words, since they can't act upon that insider information, they don't really have that much of an advantage over someone doing a good amount of research about the company. And, the other thing I point out is while they're going to know the business probably better, like I'll say the CEO of Microsoft, he knows the business better than I know Microsoft. There's no doubt about that.
I think he probably ran that statement.
But the issue that comes into play as well as valuation. He can't tell you how much somebody else is willing to pay for Microsoft.
Right.
Is it worth 30 times earnings? Is it worth 20 times earnings? Is it worth 15 times earnings? There's no real, I'm going to say, understanding from the CEOs of how much other people are going to be willing to pay for their stock.
And also to the emotional part of the market because people do crazy things at crazy times and you can have a great company. And we'll just pick on Microsoft like, oh, yeah, but people don't care if there's something, all software is going to be dropped. Well, that's kind of in the news now. All software is dropping because of AI. AI is going to take away all software. So Microsoft's down. Some other companies. I think we did that last week. Did we talk about that last week, was it?
Either last week or 2 weeks ago.
Yeah, 2 weeks ago, where software companies are getting beat up because of AI. Well, that's an emotional thing. Even if you know the company very well, that's not going to stop people from selling. So you got to understand the business.
I know like Salesforce, for example, has just been absolutely hammered. And Mark Benioff, the CEO, just keeps saying it's the best the business has ever been. It's the best the business. So there is that disconnect sometimes between business fundamentals, business growth, and valuations. And sometimes a company might be talking about, the business is great, but it's trading at 50 times earnings. The market might not be willing to pay 50 times earnings anymore. And the business could still be doing very well, but it gets a market adjustment down to 30 times earnings and the stock falters.
Yeah, and that's one thing you brought up, stock trading at 50 times earnings. I mean, this is the craziness that happens, and this is when you get burnt. And that's why we tell people, you've got to understand what you're investing into because that may be great for a while. And again, a while could be a year, 2, maybe 3 years.
It could be 10 years.
10 years. Lasts for a while. But eventually that will change because everything comes back to the mean and the average for trading amount for earnings for companies around 14 to 17 times historically. So if you got a company trading at 30 times earnings, there's one or two things going to happen. Either the earnings will rise dramatically to meet that, but then usually that causes it to go even higher, or the stock will fall to meet the mean there. And again, we're talking long-term investing because when you do these things, you really just don't understand why you bought them. You don't know why you sold them until it's many times too late. So